Markets are down, but did you know that's how some people get rich? When stocks crash or crypto dips, most panic. But smart investors, they see opportunity. Some even earn passive income through dividends or staking while waiting for the rebound. It's not magic. It's mindset and patience. Downturns don't last forever, but the right moves can pay off for a lifetime.
Welcome to the deep dive.
Hey there.
So you asked us about maybe navigating a potential market downturn in 2025.
Yeah.
So we dug into some info covering, both the usual stocks and shares, but also the crypto side.
Right.
Our mission here is basically to pull out some actionable ideas, key things to think about without hopefully making anyone's head spin.
And what's interesting, I think, is how similar strategies kind of pop up in both worlds.
Really?
Yeah. Like it's less about avoiding the dip entirely and more about, how you might position yourself, maybe even benefit.
Okay, interesting. So let's start with stocks then. One thing we saw a lot was this idea of buying quality at a discount. Talking about companies with like solid fundamentals, not much debt, good earnings, maybe a strong competitive edge.
Exactly. The idea is a downturn could be a chance to get into those stronger companies, but cheaper for the long haul.
Right. So when we say strong fundamentals, what are maybe one or two key things someone should look for?
Well, you'd probably want to see a history of consistent profits. Healthy cash flow is important too.
Okay.
And maybe think about, are they a leader? Do they have that moat that makes it tough for competitors?
Gotcha. Then there's dollar cost averaging, DCA.
Ah, yes.
That's investing a set amount regularly, right? Like no matter what the market's doing.
Precisely. Whether it's up or down, you just keep putting that fixed amount in.
And the benefit is lowering your average costs over time and I guess keeping emotions out of it. That seems big in a downturn.
Oh, it's huge. Because when prices are falling, your gut screams stop or sell.
Yeah.
But DCA forces you to keep buying, often getting more shares when prices are low. It's disciplined, avoids trying to time the bottom, which is, let's face it, nearly impossible.
Okay, makes sense. Then dividend stocks came up.
Right. Companies that pay out part of their profits regularly.
The thinking being you get some income flowing, even if the stock price itself isn't climbing.
That's the idea. A bit of a cushion, perhaps.
But how do you know if that dividend is reliable? Like, how do you check if they'll keep paying?
Good question. You look at their history. Have they paid consistently? Even better, have they increased the dividend over time?
Okay.
Also, look at the payout ratio. What slice of their earnings are they paying out? If it's super high, like 90%, that might be a red flag if profits wobble.
Okay. Good point. And lastly, for stocks, ETFs and index funds. Things like S&P 500 trackers.
Yeah, the diversification play.
Spreading your money out seems, well, less risky than betting on just one or two companies, especially when things feel shaky. How does that diversification provide a safety net exactly?
Well, if one company in that basket hits a rough patch, it doesn't sink your whole investment.
Right.
Its impact is diluted. You're not tied to one company's fate. And broad market funds, historically anyway, tend to recover and grow after downturns.
All right, cool. Let's pivot to crypto then. A similar idea seems to be accumulating strong projects in a bear market.
Yep, same logic, different asset class.
Bitcoin, Ethereum were mentioned as examples. If you believe in their long-term use case, obviously.
Right.
What makes a crypto project look strong for the long run? It feels a bit wilder than stocks sometimes.
It can be. You'd look for solid tech that people are actually using or has a very clear path to being used.
Right.
A strong, active developer community is usually a good sign, too. And definitely look at the tokenomics, how the coin works. Is it designed to last? Is it sustainable?
Oh, no, that's right. The sources also mentioned staking and yield farming, ways to earn on your crypto.
Correct, but with a big, flashing Salyashin sign.
Uh-oh. Why?
Well, the risks can be significant. You need to be really careful about which platforms you use.
So what are some red flags then? Things to watch out for?
Definitely be wary of crazy high returns that sound too good to be true.
Because they usually are.
Pretty much. Also, really dig into the platform security, its reputation. And with yield farming, you need to understand things like impermanent loss. It's complicated, but you could end up worse off.
Okay, noted. I caution that. Another crypto idea was following smart money.
Watching what the experienced folks, the ones with a good track record, are doing.
Especially if they're buying when everyone else is panicking.
Exactly. It can be a sign of long-term confidence. But tracking that in crypto isn't always easy.
How would you even try? It seems pretty anonymous.
It is often anonymous, yeah. But there are tools, on-chain analysis tools, that can spot large movements between wallets. Sometimes you can track wallets known to belong to big funds or VCs.
Interesting, okay.
Following announcements from reputable crypto VCs about their investments can also give you a hint.
Got it. And the last crypto tactic, using stablecoins strategically.
Right. Holding on to stablecoins, which are pegged to something like the dollar when the market's going wild.
And then using them to buy other crypto assets when their prices have dropped significantly.
Yeah, deploying that dry powder when you see assets you believe in long-term looking undervalued after a big sell-off.
When might be the right time? Or is that impossible to know?
It's always tough, but often those opportunities appear during really sharp, fast drops driven by, widespread fear or panic. Look for good projects that got dragged down with everything else.
Okay, so across both stocks and crypto, the big message seems to be, don't panic. Wealthier investors often use downturns as chances by staying calm, thinking long-term.
That definitely seems to be the recurring theme, strategic patience.
And we absolutely have to stress this, none of this is financial advice.
Absolutely not. Crucial point.
You have got to do your own homework, your own research. Maybe talk to a qualified financial planner.
Your money, your decisions, your responsibility, period.
What's really striking, though, is how those core ideas seem to apply everywhere.
Yeah, whether it's old school stocks or new school crypto, the principles are similar. Focus on quality, think long-term, act strategically, not emotionally.
So wrapping up, a potential 2025 downturn isn't necessarily just something to fear. It could offer opportunities in stocks and crypto. If you have that long view and use strategies like buying quality low or DCA.
And it's a big, but caution, research, understanding the risks, paramount.
Absolutely.
Which brings up a really good question for everyone listening. Thinking about all this, how do your own personal feelings about risk and your own long-term goals shape which of these strategies, if any, might actually make sense for you during a downturn?